Hello everybody and welcome to my third quarter 2023 quarterly conference call. Today I'll be talking about European banks and why I keep the majority of my portfolio in them. But before we start, a few very brief words about my background. I started investing in 2004 and the first thing I did was day trading. I day traded earnings announcements. From 2005 to 14, I invested in microcaps. Those are the stocks of very small companies. But in 2014, I noticed that that was not working so well anymore, which is why in 2014, I changed to investing in medium-sized and large companies. I've been investing in banks since 2018. Before we discuss why investing in banks might be a good idea, let's entertain some counter-arguments. And here is a quote I've taken from the first quarter report of a value investor I respect. He proudly says that we have no direct exposure to banks, and he proceeds to give a few reasons for this. The first reason he gives is liquidity risk. This is a risk that banks are uniquely exposed to. So what he says is that normally we like it when stock prices fall, but this is not the case with banks. And the reason for that is that if the share of a bank falls, then sometimes it can depress the confidence in that bank. And then, in some cases, depositors might start to withdraw their money, and if that happens, then the bank goes bust. This is in part what happened with Silicon Valley Bank in March this year. There was a social media chatter about the bank, and some people started to say that the bank is not solvent and you should withdraw your money from the bank. So then, on day number 1 of this crisis, the share price of the bank fell 60%. That accelerated the deposit outflows. And then the next day, the bank shares were halted. And when they opened again for trading sometime later, it was a 100% loss for investors. So on day number 1, you could get out of the stock at a 60% loss, but after that it was a total 100% loss. And this is one reason why many investors don't like banks. The second reason is that banks are leveraged and complex entities. It's difficult to know who exactly the bank has lent money to, how much, and are they going to get the money back. And sometimes, when doubts arise about one bank, then those doubts spread to other banks as well. And that is exactly what happened in 2008. Banks had bought mortgage-backed securities, which had lost value, but nobody was sure which bank was solvent and which bank was not. So as a result, the entire banking sector lost more than 80% of its value. And even if you were invested in the good banks, like JP Morgan, you still lost 60-70% of your investment. So it was not enough to stay invested in the good banks. All banks lost most of their value in 2008. A third reason many people don't like banks is because the financial sector is famous for attracting people who are in it for themselves. So they work in these organizations to make money for themselves, not necessarily to help the organization succeed. Here is the stock price chart of Swedbank, a Swedish bank, a high-quality bank which you would not expect to be involved in scandal. But in 2019, it was first in the Swedish TV news that Swedbank was suspected of money laundering. That caused the first share price drop. Then it was in the news that the Swedish prosecutors had raided Swedbank. That caused the second price drop. So overall, in 2019, those shares lost about 30% of their value. So it seems that what had happened is that Swedbank management had expanded in Baltic countries to make some money there, but unfortunately, they had not put in place adequate controls. So it was good for profits in the short run, but the shareholders paid the price in the long run. A fourth reason some people don't like investing in banks is that it's just macro. What this means is that bank share prices are to a large extent driven by interest rate movements and also the outlook for the housing market and the commercial property market. And it's indeed true that our stocks in the financial sector are to a large extent driven by macro movements. So if you invest in sectors like consumer discretionary or technology, then it's more important to choose the particular stocks that are going to do well. But it's unavoidable that in the financial sector, stocks are on a daily basis driven to a large extent by movements in interest rates and other macro variables. A fifth reason to avoid banks is politics. It was in the news a few weeks back that Italy has implemented a new tax on banks. So banks were making too much money, they had not passed interest rate increases to depositors, and that's why the government decided to tax them. Last year, Spain and Hungary implemented similar taxes. And finally, we have competition. Here's examples of a few fintechs that claim to be disrupting the banking industry. You have players like Revolut, Wise, Monzo, and N26. So these are active particularly in the retail banking FX transfer space. And then some people are saying that blockchain technology could disrupt some areas of banking, such as payments, trade finance, or securities settlement. Because of all of these reasons, banks have been a terrible investment for a long time. Here is a chart of the European Bank Index since 1988. And you can see that since 1998, so for the past 25 years, banks have not gone anywhere. So you have not been able to make any money in banks for the past 25 years. That's a terrible track record. So why, despite all of that, do I think that banks might be an interesting investment right now? And why do I keep the majority of my portfolio in banks? A large part of the reason is shown on this chart. It shows the German 10-year interest rate for the past 25 years. And interest rates have been on a long-term downward trajectory for a few reasons, such as changing demographics or the integration of China into the world economy. But you can see on the right-hand side of this chart that recently interest rates have increased. In part, that's because of all the COVID stimulus or the money printing that went on, which caused inflation. But even if you look at beyond just the next 1 year, I think there are some good reasons to expect that interest rates will not go back down to zero. So why is that interesting? It's interesting for banks because banks tend to make more money when interest rates are high than low. That's because the spread between the rate that banks pay depositors and the rate that they charge borrowers tends to increase when interest rates are high rather than when they are low. And that is exactly what we see in the data. So now that interest rates have increased, then the profitability of banks has indeed increased. So banks are making more money now. But what is interesting is that at the same time, the valuation of banks has not improved. So banks still trade at the same valuations as they were trading at before the pandemic, although they are now making more money than before the pandemic. And as a result, European bank shares are very cheap now. They trade at between 6 to 7 times earnings. The last time similar valuations were reached was during the 2008 global financial crisis and the 11-12 European sovereign debt crisis. So what that means is that now we can buy bank shares at low valuations, at crisis-like valuations, while there is no crisis. But could there be some reason why banks are so cheap? So to evaluate that, we go back to basics. And the price to earnings ratio of any company, sector, country is theoretically driven by 3 factors: growth, payout ratio, and the cost of equity. Now, if I think about the growth of the banking sector, then this is a mature industry. It's a slow-growing industry, but I would say that it's been a slow-growing industry since the global financial crisis. So I wouldn't say that much has changed in the last 5 years. The payout ratio, now we have more inflation than before, which is bad for payouts. On the other hand, the banks are more profitable now than before. So if you put these two things together, then you will find that the payout ratio of the banks is similar today as it was in the recent past. So payout ratios don't really explain the low valuations either, which leaves the third factor, the cost of equity. The cost of equity, in turn, is driven first by the market cost of equity. So are stocks in general expensive or cheap? At the moment, stocks are pretty expensive, as measured by the Shiller PE ratio, which suggests that the general valuation level of the market doesn't explain why banks should be so cheap. Another possible explanation for the cheapness of banks is credit spreads. If credit spreads are high, then you can lend money to individuals, to companies at high interest rates, and you can make good profits by doing that. So then there is more competition for bank stocks because they are in the same business, lending money to people. But at the moment, credit spreads are at average levels. They are very far from recession levels as were reached in the 2001 mild recession, or in 2008 during the global financial crisis, or even during the 2011-12 sovereign debt crisis. That is true whether you look at the private issuer credit spreads or public issuer credit spreads. Here is the credit spread of Italy versus Germany, and you can see that it's at average levels right now. It's very far from the crisis levels reached during the European sovereign debt crisis. So if these general macro variables don't explain why banks are so cheap at the moment, then we have to look for other explanations. And here are a few possible explanations. So first, some people say that right now there is a high probability of recession. Leading indicators show that a recession is likely sooner rather than later. On the other hand, you could say that stress tests run by the central banks show that the banking sector is resilient against at least an ordinary or even a more severe than ordinary recession. Some people say that maybe interest rates will soon go back to zero. That's possible, but I don't personally believe that, because I think that factors like commodity shortages, changing demographics are going to keep rates higher than zero this decade. Then some people say that regulations are changing that will require banks to hold more capital. On the other hand, we know about these regulations and their impact already. We already talked about political interference, new taxes. On the other hand, I would say that once a tax is announced, then its impact can be modeled, and then usually it's already in the price. Then banks have gone through some severe crises, two severe crises in the last 15 years. First the global financial crisis, then the European sovereign debt crisis. So as a result, now some people don't really like banks. So there's this preference for safer assets. And I think this is true, but as value investor, you have to go to places where other people don't want to go. That's where you get paid a risk premium. And as a result, I think as value investor, you should look for sectors. You should look for stocks that other people like to hate. And finally, there is, in my opinion, the most important explanation for the cheapness of banks, which is that there is a high risk of financial crisis compared to the past because of the high levels of debt in the global system. You have lots of private debt, you have lots of public debt. So for example, Italy, is its debt sustainable? At the moment it probably is, but if interest rates increase further, then it might not be. So ideally, as a bank investor, you would like to see interest rates stabilize at current levels and not increase further. So let's have a look at then a few bank shares that might potentially be interesting investments. Please keep in mind this is not financial advice. These bank shares do go up and down. They are very volatile investments. Here is Natwest, a British bank. It trades at 5 times earnings, a very cheap valuation. One of the reasons for that valuation is that the UK has not been performing well economically. Growth has been low and inflation has been high. And also there was trouble with the CEO of this bank. She had to resign. On the other hand, the bank trades at 5 times earnings, which means a lot of bad news is already in the price. Here is Banco Santander. It trades at 5.5 times earnings. It's a Spanish bank, but really a global bank. It has operations not just in Spain, but in the UK and all across Latin America. So you get a bit of global diversification, but still at the European bank valuation. The previous 2 banks are predominantly retail banks. If you want to take a little bit more risk, you can also look at investment banks. Here is Societe Generale, a French bank, which trades at 5 times earnings. It hasn't been performing that well this year, but it appears that next year they will earn more interest income, the profitability will improve, and if that happens, then the shares look very cheap. And finally, here is a chart of a bank that everybody loves to hate, Deutsche Bank. Deutsche Bank didn't make much money at all in the last decade, but it seems that helped by the higher interest rates, the turnaround that the current management team is executing is finally gaining traction. So if Deutsche Bank hits its 2025 targets, then there is potentially 50 to 100% upside in these shares. So overall, the European banking sector is very cheap. You can buy European banks at crisis valuations, while at the same time today there is no crisis. I think that some of the reasons that people give for the cheapness of the banks, they are a bit exaggerated, those risks. And as a result, I believe that the risk reward in European banks is favorable. That doesn't mean that they are an easy investment. These bank shares, if anything goes wrong, they will go down 30% or 50% really quickly. But then, as value investors, we have to go to places that other people don't want to go. And today, I believe that place is the European banking sector. Thank you for listening.